Here is a question most people never stop to ask: when Europe's biggest corporations need money, which countries are home to the heaviest borrowers? The answer, as fresh data published earlier this week reveals, tells us something remarkable about how different European economies are fundamentally built, and what hidden risks lie beneath the surface. As of today, the 18th of July, 2026, Europe's corporate debt landscape is more consequential than at any point in recent memory. With interest rates finally easing from their multi-year highs, companies across the continent have been rushing back to bond markets in force. But this borrowing is not spread evenly across Europe's nations. Some countries carry corporate debt loads that utterly dwarf their neighbors, and understanding exactly why that is matters enormously for anyone with savings, pension funds, investments, or simply a stake in the economic health of modern Europe. Right now, in the summer of 2026, European corporate debt markets are at a critical inflection point. After 2 years of elevated interest rates that made new borrowing painfully expensive, both the European Central Bank and the Bank of England have eased their policy rates, and that shift has triggered a fresh and significant wave of corporate bond issuance across the continent. Companies that held off refinancing or expanding their debt during the rate hiking cycle are now seizing the moment aggressively. France stands at the top of the corporate borrowing rankings in Europe. Its major corporations have long relied on public bond markets for financing, and that deep-rooted tradition continues strongly today. The United Kingdom, despite the complexities that followed its exit from the European Union, remains the second-largest corporate bond market on the continent by outstanding volume. Together, French and British corporations account for an outsized share of all European corporate debt currently in circulation. So let us look at the rankings properly. France consistently tops European corporate debt tables, driven by its enormous multinational corporations operating in energy, luxury goods, banking, and infrastructure, sectors where firms routinely raise billions through public bond markets rather than through traditional bank loans. The United Kingdom sits in second position. London's enduring role as Europe's preeminent financial centre makes it entirely natural that large British firms tap bond investors regularly and at scale. Germany, and this is the part that surprises most people, ranks considerably lower than you would expect given that it is the continent's largest economy by gross domestic product. German companies have traditionally preferred what is known as relationship banking, borrowing directly from their long-standing house banks rather than issuing publicly traded bonds accessible to global investors. The Netherlands also deserves specific mention. Its status as a European financial and legal hub means many multinational corporations book their financing arrangements through Dutch entities, which inflates the country's figures noticeably. France's corporate debt culture has genuinely deep roots. French companies, particularly the giants of the CAC 40, France's benchmark stock index, have been sophisticated bond market participants for decades. Firms in the energy and infrastructure sectors routinely issue bonds denominated in both euros and other major currencies, accessing a global pool of institutional investors. The French government has also historically encouraged corporate investment through structured financing vehicles, which in turn normalizes ambitious debt levels at the company level. In the United Kingdom, the picture carries its own distinctive character. Bank of England Governor Andrew Bailey made headlines just this week by stating that regulatory red tape in the City of London should help to, in his words, flush out excessive bank profits, without capping them outright. That tension between bank profitability and lending conditions has a direct knock-on effect on how much British companies choose to borrow from capital markets versus approaching traditional high street and investment banks. Germany tells a genuinely fascinating counterstory. As Europe's largest economy, one might reasonably expect German corporations to dominate the continent's debt rankings. Yet Germany's famous Mittelstand, the vast and intricate network of small and medium-sized enterprises that form the true backbone of its industrial economy, typically borrows from regional savings banks and cooperative lenders rather than anything approaching a public bond market. Even Germany's large listed companies have historically been considerably more conservative borrowers than their French counterparts. This is partly cultural. German business culture tends to value financial prudence and self-funding through retained profits rather than leveraging up. It is also structural, given the remarkable strength and density of Germany's regional banking network. That said, this culture has been slowly but meaningfully shifting in recent years. More German firms have turned to corporate bond markets, particularly as bank lending conditions tightened during the rate hiking cycle of 2022 to 2024. The gap between Germany and France is gradually narrowing, even if it remains very substantial today. The single most significant recent development in European corporate debt has been the post-rate cycle refinancing wave now well underway. Between 2022 and 2024, central banks raised interest rates sharply to combat stubborn inflation, making new borrowing genuinely expensive for corporations of all sizes. Many companies responded by extending existing credit facilities and deliberately delaying refinancing. Now, with rates lower, that pent-up demand has been released all at once. Data through the middle of 2026 shows a sharp increase in investment-grade corporate bond issuance across Europe, particularly from French and British firms. Adding a further layer of complexity, China's economy is now growing at its slowest pace in more than 3 years, according to figures published this week. For European exporters with significant exposure to Chinese demand, that slowdown can create revenue gaps that companies may bridge by maintaining or even increasing their debt levels, keeping corporate borrowing elevated even as the financing environment eases. For everyday investors and savers, these debt rankings carry very real and practical consequences. When corporations borrow heavily through bond markets, they offer fixed-income investors an alternative to lower-yielding government bonds. European corporate bonds, particularly investment-grade issues from French and British multinationals, have attracted significant inflows from pension funds and insurance companies throughout 2026, as those institutions seek better returns. But high corporate debt also means elevated risk. If economic conditions deteriorate, heavily indebted companies may struggle to service their repayments, and bond prices can fall sharply, eroding the value of portfolios. For consumers, the picture is equally direct. Companies carrying large debt loads have less financial flexibility to cut prices and may choose to pass financing costs on to customers. In sectors such as energy, telecommunications, and retail, all of which rank among Europe's heaviest corporate borrowers, those cost pressures are felt most immediately at the checkout and on the monthly bill. Looking ahead to the remainder of 2026, analysts expect European corporate debt volumes to remain elevated but are not forecasting a dramatic further surge. The refinancing wave is already well advanced, and appetite for fresh borrowing to fund expansion remains cautious, given persistent geopolitical uncertainty. The situation in Ukraine continues to bear on European corporate confidence. Just this week, the European Union and President Zelensky signed a new drone deal, underlining that the conflict, and its economic consequences, shows no sign of resolving quickly. Companies operating across European markets are also watching EU regulatory developments carefully, since changes to financial rules could affect both the cost and the structure of corporate borrowing going forward. The countries at the top of the debt rankings, France and the United Kingdom, will continue to dominate European corporate bond issuance through year-end. The key variable remains whether China's slowing growth and softer global demand translate into a meaningful pullback in corporate investment plans across the continent. So, to bring everything together, Europe's corporate debt rankings place France firmly at the top, followed by the United Kingdom, with Germany lower than its economic size alone would predict, and the Netherlands playing a significant but often overlooked role behind the scenes. These rankings are not arbitrary, they reflect deep cultural, structural, and historical differences in the way European businesses choose to finance themselves. What they also reflect is exposure. The more a country's companies borrow, the more sensitive that entire economy becomes to shifts in interest rates, global growth, and investor confidence. As we move through the second half of 2026, keeping a close eye on these debt levels is essential, not just for professional investors, but for anyone who wants to understand the true financial architecture of modern Europe. If you found this analysis genuinely useful, subscribe now and hit the notification icon so you never miss our next deep dive.